I'm Rob Levine, I'm Special Features Editor, and I'm going to be talking to you about media for equity, which is a bit of a niche part of the corporate venture capital. You can tell it's niche because we also have the most brightly colored shoes of any panel at the symposium this week. But you know, I'm guessing none of you do media for equity directly, even though you may have worked with a media for equity fund on an investment. So why should you care? Well, we're going to kind of be exploring the idea that really what is interesting about media for equity, if you aren't a media kind of actual investor, is that this model can maybe be expanded to everyone in corporate VC as maybe a new model of open innovation, no matter what industry you're in, no matter who you work with. But I thought to start off with, as good grounding and kind of intro all of you to everyone. Vinay, let's start with you. You run Channel 4 Ventures, Channel 4 being one of the big TV companies in the UK. Give us an idea what media for equity is, basically, for people who haven't necessarily done it, and how you invest.
Sure. So Channel 4 has reaches 50 million people every month, and has a very small subscription service, and therefore makes most of its money from advertising. The idea when I joined just over 10 years ago was, could you give that advertising, which has a unique cost to us, right? So could you give it and get into some investor rounds? And at that time, that's what we do. And so we've done about 80 deals since then, getting close to 100 million AUM, and we swap millions of pounds of advertising in return for generally syndicated investment deals where they're really non-strategic, I'd say. Of course, there are some which might fit better with the editorial palette, and we might get more excited about some of those. And then we sit along for the ride, and we get the same terms as the other investors, mainly. We've started to set some pricing for these deals now. But the cash comes in afterwards, I'd say, because of the experience you get in the market. But we started off passive, and now we're a little bit more active. It's still a passive equity model, and we're building a portfolio. And it's, I would say I've built the portfolio extremely capital efficiently. So,
good.
So they have positive DPI.
Okay, and Nico, you kind of German media pool, slightly different model. Essentially, you aren't a media company, but you work with 50 German media companies as LPs. So give us an idea, why can't they do what Vinay's doing at Channel 4 Ventures and just do the whole thing directly?
Yeah, very good question. Also very happy to be here and to be in this corporate venture capital forum. What we do is a little bit different from what Vinay does, as you said, because we're independent. But there is a Channel 4 equivalent in Germany, so a very large broadcaster that directly does media for equity investments. And then there's us. And what we do is we help the medium-sized media groups invest in the startup ecosystem. These are media groups that are let's say the second tier of whatever industry they're in, out of home, print, TV, radio. They still reach substantial audiences. They have fantastic quality media, but they cannot build up their own venture teams. And so what they do is they provide us with their media inventory. We provide it to startups, and effectively we also engage then in the media for equity investment model. We have done more than 40 investments in startups. Also, maybe similar sized to what Vinay has done. We've been around for about 12 years. And we've had some about 4 or 5 IPOs, about 10 exits, and our media partners are very happy with the model.
Cool. And Piyush, you've kind of been on both sides of this because you've obviously background in Times Group, like very big Indian media company with brand capital, like their big ad for equity arm. And now you're running Mercurius Media Capital, which kind of does it similar, I guess, to Nico, but in the US. So I'm going to ask you 2 questions. Number one, what kind of startups do generally take media for equity? And number 2, why can't they just raise money and then just spend the money on advertising themselves?
Right. I think maybe I'll touch a little bit about how we arrived where we are today with Mercurius Media Capital to talk about our investment thesis and what are the kind of startups that work with us. Like you mentioned, my journey with Media for Equity began with the Times of India Group, a large media conglomerate based out of India, 180-year-old organization. And the group started making investments using Media for Equity model in early 2000s, right when the digital onslaught was about to begin. The group wanted to safeguard its interest around the print media, which is still a very significant form of media in India. And between 2002, 2003, and 2024, the group has invested in over 1,100 companies, has invested over $4 billion of its media assets via the Media for Equity model. We then brought this model in 2015 to the US, where we started investing in companies that wanted to expand from international markets into India. And we created something called Brand Capital International, made around 50 investments during this time. And that led to the idea of Mercurius Media Capital, which was formed around 18 months ago, with the thesis of helping media companies who want to deploy their media assets in other ways than just regular advertising, and invest it in the fast-growing startup ecosystem to compound the value of their media inventory. So the kind of companies that we look at are often companies that are at an inflection point. These are companies who have already had a proven business model, they've had some revenue traction, and they're now looking for that hyper-growth curve with the help of marketing and media. And for them at this point, it's very important to build a moat around themselves with the use of branding, which is where we come in and we help these companies grow and scale. Why we believe that these startups cannot just go to a venture capital fund, raise capital from them, and then use that capital towards marketing and media. Of course they can, and that is what is prevalent right now. However, in our experience of working both with Times Group as well as Mercurius, what we came to realize is that when you have a publisher working very closely with you in the deployment of that media, the efficacy and efficiency of that media goes up significantly. And then as a startup, the founder and the CEO of the company are entirely responsible for focusing on the product and the innovation around product, while marketing and media can be left to people who are best at it, which is the publishers who understand this media well. Which is why it makes sense for venture capital funds to bring along a Media for Equity investor to help these companies grow and scale with the help of this media.
Okay, great. So we kind of have a grounding, which is good. But having said that, most companies, most corporates aren't media companies. So Vinay, I think obviously you are a media company, you're part of a media company. But what if you say we're in a completely different industry? Do you think this whole kind of services for equity model, how far do you think it could be expanded in theory?
Well, I think I was doing some thinking about this, and I looked at, I work in consumer investments, and I thought about who are the biggest consumer investment companies out there and who are doing CVC, and they have easily north, I thought of Diageo and Unilever, and they easily have 5 billion in revenue. We have $1 billion in revenue, and we wouldn't have cash to deploy, right? So what I think is, and I really do think that if you think more broadly and creatively, what have you got? What capacity have you got? Is there something somewhere where you could give? Is it time to get my cheat sheet out, Rob? Yeah?
Yeah.
So
go for it.
So you could do logistics for equity, right? So if you're UPS, you could take your cold chain logistics, which you're having to invest in anyway, and you decide that you're going to innovate to own some part, because you're seeing these companies grow, for example, who are your customers, and you could say, I'm going to offer the service 3 million. Obviously, there may be a cash or internal cost for that, but it may be lower. And you offer them returnable packaging with a weekly, new DTC product, and you offer them, and you take 20% of the equity. And I think it's a little bit about thinking about, so what have you got? What could you give? What is the unit cost of that, and how? Because your entry cost could be lower than the cash to get in and build stakes. And I think you could do that. Well, my cheat sheet is 3 pages long.
Give us some, I guess, just one-off examples.
Manufacturing for equity. So you could develop a kind of smart hydration patch, say, which measures your electrolyte loss. you come up with some clever technology, you're fed up of supplying and seeing this people make this IP, so you're going to offer custom, because you're Foxconn, say, or Flex, which makes wearables, or Siemens, you could do custom prototyping, low volume production, quality testing, and assembly, and own 25% of one of your future customers.
And Piyush, like you've kind of done a little bit of this kind of thing already, like in India. You were like saying, I think, with companies like Uber and Coursera. Like, give us an idea of how that worked in practice.
Right. So when we first started in the US and we were trying to build the US-India bridge, we started looking at some of the more marquee names, well-known brands like Uber, Airbnb, Coursera, House, Headspace. And we helped these companies grow and scale in India. The way we'd work with these companies is, of course, we'd provide them media assets to help them reach out to their consumers. But when these companies like Uber were thinking about India, in specific case of Uber, they already had a homegrown player in form of Ola, which was significant competition for them. So they had to understand the consumer psyche. They had to understand how to navigate their way through the complex labyrinth of India. When Uber landed in India, they ran into a number of regulatory issues. The operations were shut for a year. So we helped them get their foot in the door in the right places to help solve for that problem. We helped them hire their India management. When Coursera landed in India for the first 3 years, they sat out of our India offices as their headquarters, and they worked very closely with our sales team to go sell in the market. So the model was bespoke in that it was slightly different for everybody, but the mode of transaction was essentially media for equity. What we would do for them on the strategic side would essentially be to help one of our portfolio companies grow and scale in that market. And the result speaks for itself. In case of Uber, its second largest market now is India, and it has grown to a point where it's only 10% behind in terms of number of rides per day behind the largest player in the country.
Can I jump in maybe just with a small comment? I think that not any service can be, let's say, transformed into an equity investment. It has to have specific characteristics. Nobody knows India better, I would say, than the Times of India group. So you were the perfect partners for Uber to give them an introduction and a launch in India. And also when we do media, for example, we provide media, we are a large part of the spend of these consumer-facing companies. So media spend can be 40, 50, 60% sometimes of the spend of these consumer brands that are scaling rapidly. And if we have a solution for that huge amount of spend, that's also very, very valuable. So it can't be something which can be, let's say, easily replaced or something which is not terribly important. It does have to be instrumental for value creation within that startup.
And to link to that, there's a trade that the organization wants to do. So it ordinarily, a mature business, the trade is usually done with cash, right? It's a trading relationship. Here, you might be going a stage earlier. There may not be quite as much cash available where the trades, and so in this instance, obviously, it has to be a fit. There's got to be a trade that, and then you start to trade. You could trade the equity.
Yeah, because one thing I was interested in is, like, you look at all the kind of companies you invest in, you all have one thing in common. They all got to the point where they actually need to spend money on advertising.
Yeah.
So, like, I mean, which kind of begs the question is, if you were to expand this to a load of different things which are all kind of like, I guess crucial to the business, can you also expand, like, the range of kind of startups that are kind of eligible for this kind of thing? I mean, Nico, I guess like a lot of companies you work with are kind of coming to the German market. That's why they need you, kind of similar to India. Like in theory, though, could you not like expand this dramatically if you were kind of to extrapolate this to like other kind of big areas of need?
Sure. You mean that we would form some kind of, instead of just having media groups as our partners, we could have many other types of, let's say, industries or segments contributing to our pool.
Well, also, I think like the kind of startups you're looking at, like you can go to pre-revenue or like pre-product even.
True. Yeah, that's true. It would expand, our footprint considerably. I mean, it already is actually quite large. What we always say is we invest in everything that's not media. So that's one of the major misunderstandings in media for equity, is that media for equity is actually investment in media companies. It's investment in every single company that's not a media company, because what we're doing is we're providing media to companies that can use media to grow. And so it's already very broad. We are in health, we're in fintech, we're in age age tech, we're in wellness, etc. So we try to, help anybody who's building an emerging brand. And then if we would add other players to that, which also would have essential and, let's say, irreplaceable services that these startups could use, we could be even broader footprint. That's true. It's a very interesting idea.
And
yeah.
If I may add, from a life cycle stage standpoint, you brought up the fact that can we invest in pre-seed companies or early stage companies as well. I think what we have to understand is the company ready for the infusion of very large amount of media? And can it have the operational capability to then withstand the amount of interest that it'll have from the market with the backing of that media? So it needs to be at a stage in its life where it has proven its business model, it's already tested the revenue model in the market, and it now is looking for a very significant growth in its brand as well as its visibility in the market. I
think maybe one thing like a lot of people be wondering isn't like what we're talking about basically just part of the existing kind of CVC model, where if you are a strategic investor, you're already kind of looking to maybe form a partnership with the startups. Like, what do you think it is about this model that makes it kind of fundamentally different to, I guess, what a lot of other people are doing right now, like in general?
I think it's just a clever way to make money and be part of the ecosystem. And it's not, I'm not in this situation. You're not deploying cash to be part of the ecosystem, and I think it's super smart, right? So that's. And it allows maybe, again, like, the company, the size of the company we are, $1 billion a year, the amount of cash it's got, which is about, it wouldn't spend this money to get into the ecosystem. But of course you end up with I think we have we're a very different culture inside the company. We're still inside the company. And I think our execution capability, the way we break down problems, our analysis, I think it leads, it sets a bar for the other. It has a financial influence, but also like a gentle kind of cultural influence.
I think your question is really quite interesting, because I think every CVC fund you would speak to at this conference, and I had some great conversations already at this very wonderful day, is that everybody thinks that they're bringing strategic value to the company, and they're all bringing it in different ways to their portfolio. And some are doing this in very clever ways. I think one way where Media for Equity is actually different is that on behalf of our media groups, we're investing in our clients. And so we're investing in startups that one day will buy media services from our media groups. And so our media groups have a strategic interest in understanding the buying behavior and how these startups are actually using the media. And that's extremely valuable. So one thing maybe that you could all take away is there a way also to invest in emerging clients in your industry, and not just think about the supply chains or think about, let's say, your operations, but even very downward facing the actual clients that you will one day serve?
Yeah, and I think, sorry, go on.
No, I was just going to add to what Nico said. I think that is a very important point as to why Media for Equity has worked for the publishers it has worked so far. I mean, there's of course the whole element of financial returns that it's centered around, given that it's venture capital. But at the same time, there's this whole idea of category creation. You go and work with companies and startups and advertisers who you previously never worked with. And by introducing those to your set of advertisers, you then have the competitors also start following suit and come to you and start advertising with you, either in cash or in equity. And over time, it creates new categories of spenders that previously didn't exist. We had instances of this when we were doing this with Times Group. In 2002, 2003, real estate as a category had never spent with us. We started making some of these investments under our Media for Equity model. One player started working with us, their competitors started following suit. 20 years later, real estate is the second largest category of cash spenders in our advertising category in India. So it really stirs the pot in terms of bringing visibility to the platform and what it can do for a certain category that has otherwise always turned a blind eye to a certain kind of media.
Can I do a little tiny anecdote? At the beginning, when you start a Media for Equity fund, the salespeople are looking at you with a lot of anxiety, because they're saying, wait a minute, you're giving away the thing that I'm selling to my clients. How can you do that? Okay, equity, but 10 years down the line. But afterwards, your salespeople, they love you, because they realize that you're doing what Piyush also mentioned. You're creating whole new categories. You're creating new clients that will one day be big spenders with you.
And one of the things I actually find really interesting about this model is it's not like kind of say, if you invest, say, like an amount of money in a startup in return for equity, and you can kind of see how they like spend their money in general. But you guys actually track the advertising, like the effect of the advertising when you actually kind of provide the equity, because the startups need to like some kind of evidence it's working. Like, do you think that's kind of something that maybe, if we're kind of going to pursue this services for equity thing going forward, that maybe like the CVCs or the corporates are going to have to actually be able to demonstrate direct value, like in return for their service?
I would say for advertising, which is very specific, it's a general challenge. It's an industry-wide problem insofar as 3 people will look at a situation and come up with a slightly different answer whether it's worked or not. But to that point, in terms of behavior and spending, to get the insight on what's happening from an equity perspective is very useful. But specifically with advertising, I think it's quite well. I don't think they've solved the problem yet. So.
Well, it's definitely easier in some segments of media than in others. So with television, we can track quite well. With out of home, it's a lot more difficult. Radio also very difficult. Print very difficult. But there's always ways to kind of find measurement techniques, and it's really important to measure, because what you want to do is you don't just want to prove to the startup that it's valuable. You also want to prove to the media organization that how does their media work? In what instances does it work better than in others? That's kind of one of the reasons why they're engaging with you in the first place. Okay, and then I guess kind of to finish off the main questions, just wanted to extrapolate what kind of thing this might look like in theory. So, say Piyush, start with you. You've obviously worked with a lot of early stage startups, mostly consumer. When they are in that kind of that early Series A kind of thing, what do you find? Not just media, but what do you find the general kind of things they need are? If a company kind of is at that stage in order to grow, that maybe a corporate can provide them.
I think if a company is at a stage where it's at a Series A, it's raised significant capital or capital enough that it can sustain its business for a few years, at this point it's really important for them to distinguish themselves from their competitors, and for them to be able to build a brand. And because in any particular category or subcategory, you'd see a number of similar companies operating, and the only competitive moat that they can build around themselves at this stage is their brand. So, which is where media for equity really comes in and helps these companies get the visibility that they're looking for, get the eyeballs that they're looking for. And I think that's essentially where we also find our sweet spot in our portfolio, both on the brand capital side as well as on the Mercurius side. Almost 60 to 70% of our investments are in companies that are Series A to Series C, because that's really where we believe we can make a difference.
There's one important differentiator. We work with media groups that are established media groups, so they're the traditional media groups versus the global platforms. And one thing that does work very well for the startups is trust. So it does still make a big difference whether you're advertising on television, whether you're heard on the radio while you're driving your kids to school, or whether you're on a huge out-of-home poster. It builds up much more trust. And in some areas for startups, this is very important. For example, in health or in fintech, to have that trust of the consumer. So there's this secret weapon that traditional media still has, and which startups can definitely use.
And Vinay, I know you have the cheat sheet there kind of thing, but I was going to ask, because obviously all 3 of you are from different markets, how transferable do you think this model would be in theory across markets? Or is it something that maybe will work in certain, markets, for certain services, but maybe not others?
It's a good question. I think broadly syndicated investment in the venture style is a global market. And it seems to be prevalent around certain centers. But certainly I feel like I've done deals in US, which bring in companies over here. And I've done investments with Nico. I've done investment with Piyush with an Australian company, which has come over here. And I wonder whether, if you're going to expand it out, it has to probably be linked to some of maybe the bigger centers where there's likely to be more innovation, but it just takes one move, right? So if I use the drinks brand like Diageo, they could be any drinks brand, 20 companies around the world. If they came to me with a plan, here's some excess capacity, here's our brand capability, I could probably figure out a multi-million, 10 million, 20 million, 30 million deal and do a partnership with a distillery outfit, and they could be based in Bolivia, right? I don't care. Because they're going to target global customers wherever they are, right? So, and it's and as long as they're going after UK eyeballs, I'd strike that deal. I'm sure of it, right? So.
And so Nico, I was just going to ask, as someone who actually works with a lot of corporate LPs, like how scalable do you think that actual model, your model is, in terms of actually putting something like this together, where you're not maybe one corporate doing it directly, but you're working with, say, I guess, let's say hypothetically 50 corporates, but in different kind of areas, and you can maybe almost package these services up for individual startups in return for equity, and without the corporates really having to spend much money, and the startups kind of getting all these services for free, like cloud, marketing, everything.
I think it would be a very, very interesting thing to do. I don't think it's been done yet. So, I mean, what we've really focused on collecting media groups together, and it's still been challenging. It took us 10, 12 years to build up to 50 media groups. But at the same time, it's we understand the industry, we understand the types of startups that we would invest in. So here, it's much, much broader, so it'd probably be much more difficult to get the players together. But if it would work, and you could get these players together, it would be very, very interesting. I thought it was interesting what JetBlue mentioned 2 panels ago, that they've moved from just being a corporate VC for JetBlue to now being a VC for all corporates in aviation. And so they've done something very similar, still within one industry, however. So what you're suggesting, cross-industry, that's probably more challenging to do.
You think it would maybe work better where you had a collection of kind of, I guess, say, logistics providers and manufacturing providers who are all kind of working together, and they could maybe target specific kind of like startups? I mean, would that kind of really work? Because do you typically need more than one of those if you kind of are a startup?
Probably. It's hard to say, because of course getting competitors together and getting competitors to cooperate is always a huge challenge. So maybe even having one from each segment, but very relevant and valuable for startups. That would be a way of doing this.
Cool. Well, I think we're bumping up against the roundtables now, but we do have a couple of minutes left. Are there any questions from the audience? No, in that case, I'll just ask one last question to each of you. You've all been doing this a while. Where do you think media for equity is going next in terms of how it's evolving as kind of an investment form? I'll start with you, Nico.
So we're thinking of expanding the range of media partners to new types of groups, for example, influencers, and which are much harder to deal with because they're not corporates. They have their own kind of way of doing things, very individualistic as it obviously is. But I think we want to expand into everything that is about reach, trust, and so it's more about expanding the range of partners. That's what we're doing.
Vinay.
We will grow. Advertising is a kind of evergreen component of our ecosystem. I'd like to work with other publishers too, so not dissimilar to what Nico's doing. So, but it will grow for sure. And I wish we started 10 years before we did, because we'd have much bigger fund right now.
So by the publishers, you mean like cross-channel kind of stuff, like?
Yeah.
Okay, great. And Piyush, how do you kind of see things going?
So if you look at media for equity, since the 1980s, the model's been around, and you'd have instances of deals being done sporadically in 80s, 90s, and early 2000s by groups who were looking to find ways to use this perishable inventory and deploy it to make the most of that inventory. That model has since changed to corporates and media companies becoming more strategic and finding ways to use their media for equity arms as business development tools. What we are trying to do with Mercurius, where we are trying to pool together a number of media companies, and what we've done is we've created a limited partner, general partner pool. Essentially, we are representing these limited partners as their general partners and making investments on their behalf. I believe increasingly we'll see more and more of that along the lines of what Nico or Vinay said, where you'll have many media companies coming together in various forms and investing. But then you'll also have ancillary services. So we are working with media agencies now and trying to bring them on board to see if they can also extend their services to our companies. So I think in the long run, it would be an evolution of form. At the end of the day, the incentives are aligned. Everybody wants to use this as a tool for business development. And in that, the model has already served well for Media for Equity. I think it'll naturally gravitate towards services for equity.
Okay, great. Well, thank you all for speaking to us, and thank you all for listening.